In this module, we're going to introduce mutual funds. So this module introduces mutual funds, which is a way of holding a number of stocks, or any other investment for that matter, in another investment vehicle, and then you own shares, or the investor owns shares in that investment vehicle. This is covered in readings 3, so another reading for you you can look at. And again, we cover mutual funds.
Mutual funds work as follows. Investors will place their funds or money in funds, and fund management will invest those funds in assets. Those assets typically are specified, or are always specified, in the prospectus, so an investor will know the types of assets that will be invested in this fund. The investor will then receive returns from those assets, and fund management will collect a fee for making the investments on part of the investor. Investors will own shares in the mutual fund, and those shares will be valued at the end of each business day based on the market value of the assets in the mutual fund minus the liabilities. And the liabilities could arise from a variety of sources, but for liabilities of the fund itself divided by the number of shares. So on each given day, net asset value will be calculated for a share in a mutual fund, and that net asset value again will equal the market value of the shares minus liabilities divided by the number of shares. Again, the market value of the share would be, if it's composed of stocks, the value or the number of shares owned by those stocks times their market value as of that day. Given this, the net asset value will change from day to day due to changes in market valuations of the investments in the mutual fund. A major difference in mutual funds is whether they're an open-ended fund or a closed-ended fund. An open-ended fund is composed of securities, and the number of shares in that mutual fund can change from day to day to day. New shares can be purchased, and existing shares can be redeemed by those people that own those shares at the end of each business day at the net asset value. Given this, the number of shares can change from day to day to day as individuals buy shares and sell shares. There are two disadvantages to open-ended fund. The first is that the investor in those funds can only redeem those funds at the end of each business day. This is a small advantage, but can have some adverse impacts. If, for example, during a day an investor knows that the stock market is falling dramatically, they can't do anything about it with their mutual funds or investments until the end of the day. Also, another advantage is that there can be taxable events created even if the investor doesn't change any position. A taxable event can occur as the funds, and it could be even unplanned for the by the fund managers. Fund managers will have to buy and sell assets as individuals, as the net shares in those mutual funds increase or decrease. Selling shares of common stock, or selling the common stocks or the assets in the mutual funds, could create capital gains or losses, which then are typically pushed through or pulled through to the investor. Closed-end funds are also composed of securities. However, their number of shares are fixed. So the shares will not change. The shares can be traded between individuals, and that trading does occur much like a common stock. But the amount of invested is not influenced by people buying into the fund or selling out of the fund. Again, the total investment in the mutual fund doesn't change except what changes in the market value of the underlying securities, and not because of net investments or disinvestments out of the fund. Investors typically pay a brokerage commission to purchase into the fund, and the value of those shares of the fund may differ from the net asset value. Positive, or if the value exceeds the net asset value, that would typically indicate confidence in the fund managers, and values below the net asset value would indicate that the the public or the investors are not confident about the management of that fund. Taxes on either type of open-end or mutual fund are typically passed through to the investor. There's two types of taxes. There's income tax on dividend distributions, or every time a stock declares a dividend, those dividends would be taxable. And there's also gains on losses on securities trading. So if a fund manager purchases an asset and then sells an asset for a gain, that would create a taxable event. Investors, once they have invested a fund, will have taxable events. Even if they don't redeem any shares or do anything else, they will have taxable events as a result of owning that fund. This applies to, in specific, to non-retirement accounts. There are taxable events on retirement accounts as well, but typically those are deferred till retirement. There are also fees on mutual funds. There could be three types. One is a front-end load, which would be a fee of 1, 2, 3% to place monies into the fund. There could be a back-end load, which could be fees on withdrawing funds from the account. There could also be operating funds, and those would be deducted from yearly returns. There typically are management fees, 12B1 fees for marketing, advertising, and distribution, and there are other fees. Again, operating fees will exist on all mutual funds, and there may be front-end loads and back-end loads as well. Fees will be listed in the prospectus of the mutual fund, and this slide shows an example for a Vanguard 500 index fund. Here we see the fees listed for investor shares and admiral shares, and investor and admiral shares differ somewhat. It's not important for this slide, but for this Vanguard 500 index fund, you can see that there's no sales charge, there's no purchase fee, and there is no redemption fee. There are estimates of annual fund operating expenses, 0.15% for management fee, none for 12B1 distribution, and 0.03% for other expenses, giving a total annual fund operating expense of 0.18%. Fees will vary from fund to fund, and here's an example of three fees. The Vanguard 500 Index, which is we shown in the previous slide, which is a passive fund, is a 0.18% fee. A Fidelity fund, which is actively managed and is one of the oldest funds and at one time was an influential fund, had us a 0.64% operating expense. The average for a large block blend stock mutual funds is 1.04%. Actively managed funds typically have larger expense ratios because of active management, and because of those fees, actively managed funds have to do better on their investments to make up for those larger expenses. Fees can have a large impact on the end result of a mutual fund, and this just gives an example. Let's take a case where an investor will invest $1,000 per year for 40 years. This would be, for example, you go out of college today, start investing $1,000 per year for the next 40 years, planning on retiring in your early to late 60s, and you invest in a fund that has an average return of 8%. If that fund has a 0.18% expense ratio, you would have $266,000 invested in the fund. 0.64, $235,000, and a 1% expense ratio, you would have $211,000 invested in that fund. So you can see those expenses do have a large impact on the end result of the fund. There are two types of management styles of mutual funds. One is passive fund, and those funds tend to or seek to mimic market indexes. Given that they're seeking to mimic market indexes, there's very little professional management or decision made about which investments to put in those funds. Hence, these funds typically have low operating expenses. Active funds seek to outperform the market, and they have professional management. That management seeks to pick high-yielding stocks or other assets to be included in the mutual fund. Given that there's this type of professional management involved in the fund, these actively managed funds typically have higher expenses. Those higher expenses have to be offset by higher returns for actively managed funds. Mutual funds will also differ in the type of investments that they make. Some will only invest in specific sectors, for example, the financial sector, transportation sector. Some funds will also differ by the market capitalization or the size of the companies that will be included in that mutual fund. There will also be some differences in their desired objective. Are they an income or value fund, i.e., do they seek stocks with high dividends? Are they a blend of income and growth, or are they a growth fund? Are they trying to pick funds that will have high growth rates? You can get information about funds from a variety of sources. This is an example from Morningstar for a fund that I selected here, and Morningstar is an investment advisory company. This fund that I picked is a large cap stock, as you can see on the block on the right hand side, and this is a fairly common way of showing how mutual funds make their investment. This fund has a large cap stock, and it seeks an objective of a blend or a balance between value and growth. So again, this, for example, is a example of some of the information that you can gain on mutual funds. This happens to come from Morningstar. I'm now going to show a couple websites of two companies, Vanguard and Fidelity, that offer quite a few mutual funds and ETFs and are big players in the mutual fund and ETF business. We're going to go to Vanguard, so I'm going to type in Vanguard in here. There it is, Vanguard Mutual Funds. And we're going to go to the personal investor site, and I want to show you a couple things. And Vanguard is one of the companies that is again big in the mutual fund ETF business, as well as retirement planning and offering services to investors. Vanguard is known as a company that has low expenses on its mutual funds and ETFs, and I'm going to now click on this Vanguard fund and ETF, and you'll see we get to Vanguard mutual funds, and I'm just going to list them by name, and this will give you a feel of the different types of mutual funds that exist out here. There's a 500 index, which we'll come back to later, but they have funds for asset allocation, a balanced asset allocation, and here you can see stock, large cap bend. They have a money market, balanced bond funds. We haven't talked about bonds, but a bond mutual funds would be something that you might combine with a stock fund to give diversification, diversified equity, and you again just see the various types of funds that exist out there. I wanted to start here with Vanguard 500 Index. I'm picking this one because this would be an example of an passive index. What it's trying to do is invest, as it says here, invest in stocks in the S&P 500 index and mimic that fund. What it's trying to do again here is it's a domestic stock, large blend, has an 0.18% ratio, $30,000 minimum to invest in this fund. Many mutual fund companies will then also give you examples of their performance. Here you see price as of 9/10/2010, and again this fund will very closely match the S&P 500. And here you can see down here S&P 500 index 4.79%, 500 index. S&P 500 did a little bit better than that last year. Comes fairly close, but not exactly. And again, part of that issue is with the balancing and rebalancing. Every day, those activities have to go on, and that could cause a bit of differences between the index and the fund itself. But as you can see there, they're highly correlated. Again, we have an example here of a fund. I picked the S&P 500. Here they do again, just as Morningstar did, give an example of where this portfolio would fit. This would be a blend as far as value versus growth, and it would be a market cap, a large market cap. Again, over here you can go back, you can see the overview. Down here, and I would suggest that you do this, view prospectus and reports. You can see the prospectus of this Vanguard 500 fund. Again, these mutual funds are easy to invest in. One could open up an electronic account or electronic account with Vanguard and make these investments without just opening an account and placing funds in that account. Another company that I wanted to take you to was Fidelity. Fidelity is one of the longest or has been in the mutual fund industry a very long time. One of the influential companies that got this industry going. We're going to go into Fidelity, and here's their website. Again, very similar, or you can open an account and has many of the same looks and feels as the Vanguard site. We're going to go into investment products, and again, mutual funds. And you can see we have Fidelity mutual funds over here, and you can see different types of lists that they offer. I am going to go, let me just go here for 5-star. Let's go to domestic equity. Again, and I'm going to click on one of these, Fidelity Contra Fund. Here you can see the performance of this fund: 1 year, 3 year, 5 year, large growth. They also give a Morningstar rating, which would be again the website that I showed you earlier, how they rate this mutual fund relative to other funds. Here you can see what the investment strategy is: investment in securities of companies whose value FMR believe is not fully recognized by the public. So this is an example of a mutual fund that's actively managed. Again, you can see its returns. You can look at its performance and risk: 1 year, 3 year, 5 year. And you can see how it compares to the S&P 500 here. Again, for 1 year, it has done better. 2, 3, 4. You can see that they give a beta 0.87, which would indicate that this stock is, or a mutual fund is, less risky than the market, and a standard deviation as well. They give ratings, which you can look at. Composition. I'll tell you what their top 10 holdings are, the countries in which they're holding, and the sectors, and also fees and features. So this company, or this one, has an expense ratio of 1.02, and again, going back, this is an actively managed fund, so its expense ratio is 1 compared to 1.02 compared to the 0.18% expense ratio for the Vanguard 500 index fund. Again, just a couple of examples of two companies that offer mutual funds. There are others. Pick these two out because they're large and have been in the industry a while and have good reputations as well. But again, a couple of takeaways. You can get a lot of information about these funds on websites, and Morningstar. You can also get Morningstar evaluations of all these sites, and Morningstar would be a independent evaluation of it. And there are a lot of opportunities for fitting different type of mutual funds into different type portfolios. A summary here of mutual funds. It's a very important asset for personal investment, and I suspect that if we would go around the room, most of you may actually hold one of these already, but will likely hold one or more of these. And the second point here is there's a variety of types available. A couple of dimensions that you could look at: open versus closed, open fund versus closed fund, active versus passive management, value versus blend, capitalization, and also the type of industry those funds are invested in.